Welcome to Tax Implications of COVID-19, New Legislation and IRS Guidance, sponsored by the ABA Taxation Section. Moderating the program today is Sheri Dillon. Sheri is an attorney at Morgan, Lewis & Bockius, LLP in Washington, D.C. Focuses on federal tax controversy matters, guiding clients through IRS examinations and appeals, the administrative claims process, and litigation. Sheri, you may now proceed with the program.
Good afternoon. As mentioned, I'm Sheri Dillon, and I am here today not only as a partner at Morgan Lewis, but in my role as Vice Chair for Pro Bono and Outreach for the ABA Tax Section. Welcome to today's program, which is the first of a series that the section will be providing regarding the tax implications of COVID-19. We hope everyone in the audience is healthy and staying distance, which we are all doing. So we hope not to have any technical difficulties with this today, but if we do, we will get back on track, and we appreciate your patience. I'd like to introduce my panelists quickly so that we can get this program started and get into all of the things we know that are on everyone's mind with all of the recent legislation and guidance. First, I'd like to introduce Jennifer Breen, who is one of my partners here at Morgan Lewis & Bockius. Jennifer's practice is also focusing on tax controversy matters, but she also does tax planning. We're also, it's our great pleasure to have the Honorable Michael Desmond here, Chief Counsel with the IRS. We have Ann Gordon here, Tax Counsel with the United States Senate. And we would like to note for Ann that the views that she expresses today are her own and that she is not speaking for the United States Senate today. We also welcome Sunita Lough, Deputy Commissioner for Services and Enforcement at the IRS, and she will be speaking to us today on a lot of the operational issues that we're all interested in. Last but not least, we have Lisa Zarlinga, who is a partner at Steptoe & Johnson, I think a well-renowned tax practitioner, both in doing transactional work as well as having done some controversy work and a lot of tax policy work. So that is our panel today, and without further ado, I'll let you know of the things that we plan on talking about in the focus of today's program. We hope we're just going to start with level setting everyone where we are to date. We're going to review the slew of legislation that's occurred and the IRS response with a view to learning more about where the IRS is headed, both in interpreting the legislation so that it has its intended effect and in implementing the legislation from an operational perspective. We applaud at the tax section the IRS and its efforts so far. We have seen, in fact, just tremendous efforts by the IRS and its dedicated workforce in getting information out to businesses, employers, and individual taxpayers. We will be taking questions throughout, so please do use the Q&A box, and we will try to answer them either as they arise or at the end of the program. Quickly, I just want to give us a little bit of an update. We all see from looking at the slide of the timeline of legislation and guidance that a lot of activity has occurred during the month of March. This started with Congress enacting the Coronavirus Preparedness and Response Supplemental Appropriations Act of 2020. We think of that as phase one. We won't be going into any detail, but I think everyone is aware that it basically provided the $8.3 billion of emergency funding for coronavirus vaccine research and development. Following that, President Trump had declared a national emergency, triggering the Stafford Act, which provides the Treasury and the IRS the authority to provide relief from various tax deadlines under Section 7805A of the Code. So that's a lot of the things that we'll be talking about today. That in response to that, of course, we had the extension of the tax relief with tax deadlines and payment deadlines, et cetera, and we're eager to hear more of what is to come. Phase 2 legislation was enacted, the Families First Coronavirus Response. Following that, providing relief for those who have been affected by the coronavirus and their caretakers, which is largely a leave mandate program and associated employer credits. And that was followed by Phase 3 legislation, the CARES Act. We're now going to turn and talk about some of these things in more detail, starting with the Families First Coronavirus Response Act, and Ann Gordon will hopefully provide us some insights into the Act and its intent, as well as how it works. Ann, if you would take it away, please.
Sure. Thanks, Sheri. So the Family First Coronavirus Response Act is commonly referred to as Phase 2. This followed the large appropriations in Phase 1 for healthcare. This, of course, provided free testing and medical care, but I think for our purposes, provided sick leave for small employers. So employers under 500 employees received refundable tax credits for 80 hours of sick leave. For employees, there are kind of two paths on the sick leave. If you're caring for yourself, there's payments of up to $511 a day. If you're caring for a family member or a school closure for your child, you get up to $200 a day or 67% of your wages. Additionally, since there are widespread school closures and daycare closures, it expanded the Family Medical Leave Act, providing for 10 weeks, kind of 10 weeks after the first 2 weeks, so a total of 12 weeks of paid family leave to care for your children. As I mentioned, these are refundable tax credits, and the IRS has provided a bunch of notices on the mechanics of that, and I'll turn it over to Mike and Sunita to kind of give some more details on what employers can expect and how to apply for these credits.
Sure. This is Mike Desmond. Just to weigh in and complement what Ann had said, I think a couple of points about the Families First Act to begin with. I think the overarching public health focus here was to ensure that employees of small employers are acting responsibly and able to give sick leave in particular, but also family leave to people who should not be at work because they are affected by the coronavirus situation. So again, the public health directive for sick people to stay home and not put employees of small and mid-sized employers in a difficult situation of feeling like they had to go to work because they weren't getting paid. So there's that overarching purpose there. From a tax perspective, it's also important in the legislation to be sure that those small and mid-sized employers are reimbursed dollar for dollar for the amount of sick leave and family leave that they are required to give under the labor provisions of the Act. So from the tax perspective, we deliver the compensation to the small and mid-sized businesses through these advances and credits against payroll taxes, fully refundable payroll taxes in Division G of the Family First Coronavirus Response Act. So we've done that in a couple of different ways, and we just put out a very extensive set of FAQs earlier this week that gives direction to employers and to employees and to payroll service providers as to how to implement the credit provisions and how that whole system works. So a couple of key points to that, and Sunita may have more to add to this as well. First of all, I think what that does, and there's also a notice that we put out that provides relief from failure to deposit penalties, and all of that allows employers, small and mid-sized businesses, to utilize the deposits that they otherwise have and hold for deposit with the IRS on a quarterly or monthly basis or biweekly basis, and use those funds to pay the mandatory sick and family leave. So normally, if you don't take those funds and deposit them on your deposit schedule, there is a penalty that applies there. Here, since it's a fully refundable credit that these employers will anticipate getting when they file their 941s at the end of the quarter, it doesn't make any sense for them to have to hold that and deposit it. And again, the statute and our regulations and our guidance contemplates penalty relief to ensure that those funds are available to the employers to make those mandatory sick and family leave payments. We also have a mechanism, and Sunita and the W&I group worked very diligently to get the new Form 7200 out, which allows for an advance of funds to certain employers. So if they have no withheld employee income tax or payroll taxes to utilize to pay those wages, if they've exhausted that pool of funds, there is this mechanism through the Form 7200 to get an advance from the IRS to pay those that will be trued up when the employment tax return is filed at the end of the quarter. So Sunita, I don't know if there's anything else to add from your perspective in terms of the implementation, but that's kind of a very high-level overview of what we have done with respect to implementing that provision.
All right. Sounds like Sunita does not have anything else to add to that. So,
sorry, the Form 7200 can be faxed in, and that's a convenient way for people who aren't in the office and face-to-face, and our employees who are working remotely to be able to work the form. That's a big difference from usual mail-in. That's all I wanted to add. It's a fax-in number.
Great. And is the fax number then on the form itself?
On the instructions.
Fantastic. All right. So thank you very much. Then we will now turn to the CARES Act, and I think we will be talking a little bit more when we talk about the CARES Act, how the payroll protection and those credits interact with some of the provisions of the CARES Act. But I'll just give us a quick overview of the CARES Act, and then we'll be discussing the larger tax provisions in detail and in tandem with the IRS guidance that's come out so far. And again, we're hoping to hear that there is more to come. Just as a general comment, the point of the CARES Act, the general intent seems to be economic recovery. Let's keep employees on payrolls. Let's help businesses stay afloat, small businesses and large businesses alike, and let's provide relief and payments to individuals. I think we're all aware, or hopefully are aware, that there's been a lot of publicity that the legislation indeed does these things through various mechanisms, which we'll talk about in more detail now.
Great.
And
so,
yes, thanks, Ann.
Oh, sorry. So I think one of the highlights of the CARES Act is the outreach for small businesses and ensuring that small businesses can make payroll and stay afloat during this time. And so the CARES Act created a payroll protection program under the 7A loan program. So the 7A loan program has existed for a number of years. It's administered by the Small Business Administration. There is a network of about 800 banks that provide these SBA loans. They're normally up to about $350,000. Under the CARES Act, we've expanded that to $10 million, and that will help small businesses and nonprofits that are 501c3s and C19s, which are veterans organizations, and certain tribal businesses. This program allows loan forgiveness for the loans that are taken out for certain aspects. And so basically the loans provide 2.5 times payroll, although Treasury has noted that they expect a high volume, and this might only be 2.25% times payroll. But you get 8 weeks of payroll for your employees, rent, utilities, interest on mortgage, interest on other loans that existed before February 15th. And as long as you keep your employees employed, those loans are fully forgivable. The loan proceeds are used for employee salaries up to $100,000. So if you have an employee that makes more than $100,000, only the portion over those 8 weeks that would be up to $100,000 would be credited or forgiven, sorry. The SBA has different rules than tax, and I think that's important to note in the affiliation aspect. And so small businesses up to 500 employees, however, the SBA uses affiliation rules that are not under 318 attribution. And so if you have an owner that owns another business with 400 people and you have 500 people, even if they might only own a minority share, all of those employees would count. So the SBA has loosened these rules, or the law loosened these rules a bit for Code 72 industries, which are hospitality businesses, and those businesses are on a per location basis. The law also provided some flexibility for the administration to name other franchises that might benefit from this rule. So I think the idea is to provide keeping a large program to allow small businesses to thrive and get through the next few weeks without having to go bankrupt. And so the idea is to keep employees employed, keep businesses afloat, and hopefully in the next few weeks, when things settle down, they can reopen and resume operations. It is important to note that the loans are only forgivable if you maintain the level of employees you had earlier this year. So there are 3 different provisions in the bill that give options as to what number of employees you need. It's based on whether you're seasonal or not. The company can choose which option is best for them. For companies that have laid people off, there's also a ramp-up period after you get your loan for up to 30 days to kind of resume employment and get your headcount back up. I think the last thing is that the 7A loans interface with the other credits. And so if you're getting loan forgiveness, you cannot also get a payroll credit. And I think the idea is we don't want people to double dip. We want the government to provide support and help businesses. But this is not a way for people to, get rich or make money. And so I think that's.
And this is Lisa. Yeah, I just wanted to make another observation about how this interacts with the with the tax provisions. The CARES Act permits employers to delay payment of payroll taxes, basically from March 27th through the end of 2020. And those payroll taxes are deferred until 50% are deferred till the end of 2021 and 50% are deferred to the end of 2022. And that applies to all employers, regardless of size or type of employer. But one of the provisions there says that if the taxpayer has had indebtedness forgiven under this provision, under the Paycheck Protection Program, then they don't qualify for the payroll deferral. And I guess I have a question both for Ann and for Mike. One is for Ann. It doesn't seem the payroll forgiveness. I mean, the SBA loan forgiveness doesn't apply to payroll taxes. So I'm not sure I see the double dipping problem that there is with the employer retention tax credit and the other tax credits. And then as far as implementing that, there's been some confusion on the timing because the deferral isn't allowed until the loan is actually forgiven, which could be after the payroll taxes are due. And so I think people are wondering how that's going to apply in practice.
And so, this is Mike. I go ahead.
Oh, I was actually going to say that you guys would provide guidance and turn it over to you.
Okay. So I'll try to address a couple of Lisa's questions, and I think they're very good questions. One, I would first note that Section 2302, which Lisa was referring to, which provides for deferral of payroll taxes, is limited to employer-side FICA taxes. It is not a deferral of all taxes. I think that's an important distinction. So the big chunk of payroll taxes is what's withheld from employee wages, so that's not included in this deferral. It's just the employer-side FICA tax. Still a very big number and a very important provision, but just to be clear what that applies to. And that timing question you mentioned, Lisa, is certainly something that we're very aware of. I think in section, Ann did mention this kind of no double dipping rule there, that obviously if there is a credit provided for wages, what the statute I think is intended to do is ensure that the same dollar of wages that you get a credit for, you don't also get loan forgiveness for. So there's an intent to match it there. And Lisa, I think you pointed out that in some cases it may not be the same dollar you're talking about. It actually covers different time periods, and to some extent there isn't forgiveness of the taxes, so there's some disconnects there. We're certainly very aware of those points. We put out the first tranche of FAQs on the employee retention credit in the CARES Act earlier this week to get something out there as quickly as possible. But we do have all of those questions on our plate here at Counsel's Office and at the IRS and working with Treasury. We do expect to address many of those questions, including the timing questions, in the very near future.
Thank
you.
So,
and if I can, just before turning over, a couple of other points to pick up on what Ann said in describing the Paycheck Protection Program in particular. As she described it, and it obviously is an SBA program principally, there are a couple of intersections with the tax law, including the timing issue that we talked about a moment ago that we're looking to address and ensure there's some guidance out on that. Also, and it's in the slide there, this is not just small businesses, for-profit businesses. It's also available, and there's a cross-reference to the 501c organizations that are also eligible for the program. And then, in addition, the one other kind of tax link to this, one of probably several others, is that the loan forgiveness is explicitly excluded from income inclusion under Section 61. So if you get a loan forgiveness under this program, there's a provision there that says that's not taxable income to you as it otherwise would be under Section 61.
Thanks. Yeah, that's an important point. So should we turn over to the payroll credit?
Sure.
So the bill also provides, the law now, also provides an employee retention credit. This is for businesses that might not be eligible for the SBA program or might not want an SBA loan or the other loan program. And so the CARES Act provides a refundable payroll credit for 50% of wages for employees from March 13th, 2020 till the end of 2020, December 31st. And there are two paths in this as well. For small employers that are under 100 employees, they are eligible for this credit whether or not they're open or not. For large employees, they need to be closed. And so the operations need to be suspended, and or the gross income needs to be less than 50% of last year in the same quarter. And the employers are eligible for the credit until business gets over the 80% threshold. So there's, again, another ramp up to allow businesses to kind of resume normal operations. It's important to note that if you're getting an SBA loan, that you are not eligible for the retention credit. And additionally, this interfaces with the Families First Act, that the wages you got in a credit for sick leave, you can't also get a retention credit for. So again, just making sure that people are only getting credit once and not multiple times. And so it's also for up to $10,000 of wages per employee. I think that's.
And I think we've had a couple questions. Jennifer, did you have an observation?
Yeah, Mike, I think this is something that would be something that you or maybe Sunita could weigh in on, and that is what is considered a governmental shutdown order. And so, as it shows here on the slide, an employer is generally eligible if its operations have been suspended during this crisis by a governmental shutdown order. And I think that this section is probably the only tax provision that's going to make cash immediately available to affected taxpayers, because this is the section that allows folks to apply to qualified wages after March 12th, which is the last 19 days of this first quarter. And so in terms of getting cash quickly to employers, this is the provision that a lot of these companies are looking to. But I guess the tension here is most employers are not going to know if they really are going to qualify for this tax credit under the significant decline gross receipts test, because they're going to probably need to see what happens in the second quarter, at least, and maybe even the third quarter before they start really feeling the significant decline. So if they're going to want to take advantage of this immediately, they're going to really need to rely on this governmental shutdown order. But the problem is there's so many different approaches that we're seeing across the United States. And so you've got, you've got some jurisdictions having a, shelter in place that says, people, you can't come out of your homes, except some of these businesses still can operate with, drive up and, get a delivery to your car. You've also got, non-essential employees working from home. You've got advisories that just are warnings but no punitive implications. And so I think that there's just some concern about what this will mean and how the IRS is going to interpret it and what taxpayers can rely on if they decide to pursue this. And so, Mike, I would be interested in hearing a little bit more from you guys about how you are approaching this and what you would recommend.
Sure. So there are a couple of elements to that. And as I mentioned, we did put out the first tranche of FAQs earlier this week on the employee retention credit. We wanted to get something out quickly there. We realized there are some pending threshold questions on eligibility for the credit. The one about the scope of closure due to an order, a government order, is probably at the top of that list in terms of other questions that we need to answer. There are other ones in terms of threshold eligibility as well, what it means to carry on a trade or business. That's a long-standing question under the tax law. But I think we do certainly recognize that the other trigger for eligibility, this quarter-over-quarter decline in revenue, is one that you can't measure until the end of the quarter. So that puts pressure on that governmental order shutdown provision as a trigger for eligibility. We do have a little bit of experience, and we did flesh out a little bit in the FAQs that we did under the leave credits, because there's eligibility for leave for employees who are subject to quarantine orders. So we've thought about that and thought about the scope question that you referenced, Jennifer, in that context. And learning from some of our thinking in the leave credits, are working to draft additional guidance, additional FAQs in our second tranche that will address this issue. And again, it's one of the threshold questions for us. It is, as you mentioned, Jennifer, something that can have different application for employers, particularly larger employers. And this credit, unlike the leave credits, is available to employers of all sizes. So many of those employers will have employees and facilities and operations across many jurisdictions, which adds some additional wrinkles and complexity to what it means to be shut down or closed by a government order, which we're certainly recognize and are working to address that. So stay tuned. I don't have any specific answers as to how we'll address that, but we do recognize that's probably one of the, if not the most important question for that threshold eligibility that we'll try to address in the next round of guidance.
No, thank you, Mike. I think that's great. And one other thing, just an observation is to the extent that this is addressed in an FAQ as opposed to some other type of guidance, I think that taxpayers will just want to be assured that, 3 years from now, if they're subjected to an audit, that they can rely on those FAQs in taking the position. So I know that that's something that you guys are considering, different approaches to how you roll out the guidance, and just making sure that folks, know what they can rely on and what is just considered informative on the IRS's website.
Yeah, no question. We're going to get to it later in the program, but I know in the FAQs we put out on the 7508 Cap A extensions, we did signal in there a recognition that some provisions may actually need follow-up IRB guidance or regulatory guidance. So we certainly recognize that when we address big pressing threshold questions in an FAQ, it might be something for reliance purposes that we give a little bit of additional comfort down the road through some different form of guidance. So we'll have to see how that shakes out. I think the FAQs are a particularly appropriate vehicle in this context to get something out very quickly for people to follow. This is not an area that we're going to be looking for foot faults, particularly if they're consistent in their conduct and their reporting with our FAQs. So I would try to give some people some assurance there. This is not an area, and Sunita, I'm sure, can probably echo what I'm saying. But we do recognize that point you made as a technical matter, that we do not allow reliance on FAQs for penalty protection purposes, and did signal, as I mentioned in our 7508 Cap A FAQs, that some of those may be appropriate for further guidance through IRB notices or other reliance-based guidance. So certainly very aware of that issue.
Yeah, thank you, Mike. That's great. Thank you.
Before we move on from the employee retention credit, I just wanted to make a quick observation that the statute here precludes you from taking both the work opportunity tax credit and the employee retention credit at the same time. So I know a lot of these industries that are going to be subject to this employee retention credit also benefit from the WOTC. So I just wanted to make sure that people understood that.
Thanks, Lisa. And I want to echo with what Mike said, in that I think my understanding of the congressional intent is to make a taxpayer-friendly program and to give a lot of latitude to Treasury and the IRS in making guidance that's helpful and keeping businesses open. And like Mike said, not trying to create foot faults or other technical issues. So let's move on to the last kind of portion of the CARES Act, which is another direct lending program aimed at larger businesses, which is stemming from Treasury's Exchange Stabilization Fund. And so this program has $500 billion of direct lending. There is a carve out for airlines, airline cargo, and national security. The remaining $454 billion is just for general U.S. business relief. These loans are very different from the 7A loan program in that they are first not forgivable, and they also have additional guardrails. Like the 7A loans, there is an employee protection aspect, and the program provides that employee levels need to stay the same until September 30th of 2020. However, there's also a restriction on stock buybacks, cutting employee compensation, paying dividends, and executive compensation. And it's important to note that the stock buybacks and dividends are in effect during the term of the loan as well as 1 year after. So we have not seen much guidance on this yet. I think Treasury has been focusing on the small business aspect, and we expect guidance on this program to be coming in the coming weeks. But again, it's just another loan program allowing for mid-size and large businesses to get some liquidity during the pandemic.
And Ann, this is Mike. This is not an IRS-driven program, but I would just note that some of these provisions that you just mentioned there do have some precedent in the 2008 TARP provisions, and the IRS was involved to some extent in giving guidance on some of those limitations. So if folks have questions, there is some precedent for IRS involvement and around some of the provisions of this. So again, it's not an IRS program, so I won't speak to it, but there's something that there's a precedent for that we've been involved with and giving guidance on in the past.
I think that's very helpful. And Treasury is running this with the Fed, is my understanding. And again, I think we will get some guidance in the coming weeks. And I think these are usually more sophisticated borrowers, and so this process will be a little more complex than the payroll protection program.
Thank you very much, Ann. One thing I would like to comment on for our audience is we are being deluged with questions about the PPP and about some of the other payroll tax credits connected with all of these programs, and we will hope to turn to answering some of those questions during the end of our program. So thank you very much, and I just want everyone to know we are seeing your questions, and there are lots and lots of them, and hopefully we will be able to get to some of those answers to provide some clarification on the PPP as well as the employee retention credits, as well as also a lot of questions on loan forgiveness. And just to be clear that the loan forgiveness is not subject to COD so long as it is loan forgiveness and you have used it for the payroll costs, rent, utilities, and interest paid on mortgages. For more detail, obviously see the statute, but a lot of questions have been, would the loan forgiveness be subject to COD? And that is not the case as long as you meet the criteria. And you know what, maybe before we, go ahead. Yep.
Okay. So the loan forgiveness is only for the 2.5%. So these are 100% guaranteed by the government as well. So if people get additional money and use it to buy a yacht and then get loan forgiveness, that would be includable. So just to because it would not be used for, it would not meet the criteria of what the funds were spent on, what the loan proceeds were used for. So but just wanted to answer that one quick question since we'd had that from several different members chiming in. And one other question that seems to be coming in a lot is talking about the $100,000 total that you can seek eligibility for, and that's the PPP. So just to remind everybody, the loan proceeds may not be used for employee salaries over $100,000. And one of the questions that's been coming in a lot is just how do you compute that? What is the total? What goes into that computation? What goes into that is your salary, wage, commission, and other compensation, payment of any cash or tip equivalents, payments for vacation, parental leave,
family and medical leave, allowance for dismissal or separation, payments required for provision of group health care benefits, including your insurance premiums, and payments for any retirement benefits or any state and local taxes. And so, so I guess a scenario that we're, folks are coming up with on the questions is, so is it that your salary is capped at $100,000 and say your health care benefits are $20,000? Do I only get the 100, or does the $120,000 count? And the answer is it's capped at 100. So if you have 20 in my scenario with the $100,000 salary and then health care benefits of $20,000, you're only going to get $100,000. That health care benefit of $20,000 that goes into that computation.
Hopefully that was helpful, and we will turn back to some of these questions during the Q&A period of our session today. And we're now going to talk about one of the specifics of the CARES Act, the modifications for net operating losses. Lisa, will you help us get into the detail?
Sure. Thank you, Sheri. Certain changes to the loss provisions that were made by the Tax Cuts and Jobs Act are suspended under the CARES Act in an effort to allow companies to utilize greater losses and actually claim refunds for certain losses. In particular, the CARES Act suspends the TCJA's 80% of taxable income limit on net operating loss carryovers for 3 years. So basically the limit would not apply to tax years beginning in 2018, 19, or 20. In addition, the CARES Act allows NOLs that arise during those years, 2018 through 2020, to be carried back 5 years instead of just forward, which is what the TCJA had provided. So not only does this give rise to liquidity in that taxpayers can carry back those losses and obtain immediate refunds, it may also give rise to a rate benefit if the NOLs are used to offset pre-TCJA income at 35% instead of 21%. The provision does a couple of relatively favorable things for taxpayers who were subject to the 965 transition tax. Specifically, if any NOL is carried back to a 965 inclusion year, taxpayers are going to be deemed to make an election under Section 965N, which is the election not to apply their NOL deduction to the transition tax liability. That would, for example, free up foreign tax credits that they could otherwise use to offset the transition tax. In addition, if a taxpayer carries back NOLs to a Section 965 inclusion year, they can basically skip those years. In lieu of making an election to waive the NOL carrybacks, they can basically skip the years that are 965 inclusion years. And that will allow taxpayers to get the full 5 years of their carryback. Basically, the IRS has taken the position that if you apply a loss to your 965 inclusion, that it's treated as an advance payment of future installments. It can't be refundable because you still owe a tax going forward. And so this sort of helps taxpayers avoid that dilemma. In addition, the CARES Act implements a few technical corrections to the TCJA in the area of losses. First, the effective date. The CARES Act remedies an error that was in the effective date by making the carry forward and carry back rules effective for NOLs arising in tax years beginning after December 31st, 2017, rather than tax years ending after that date. So for fiscal year filers that had tax years straddling January 1st, 2018, that would now allow those losses to be carried back to the preceding 2 years under the pre-TCJA rules. There are also some clarifications regarding the ordering of pre- and post-TCJA losses. The legislation basically implements the explanation that was in the Joint Tax Committee Blue Book regarding how you compute the 80% of taxable income limitation with respect to when you have pre-TCJA carryovers. And they clarify that the taxable income is computed before any NOL deduction that's attributable to the post-TCJA NOL carryovers, but is in fact reduced by the pre-TCJA NOL carryovers. which is a little less favorable to taxpayers who had hoped that it would not be reduced for the pre-TCJA carryovers. The TCJA also limited several deductions that were based on taxable income, but didn't really specify how those multiple deductions would be calculated. The CARES Act addressed some of these interactions by clarifying also how the 80% computation would apply with respect to Section 250 deductions for GILTI and FDII and the 199 Cap A business income deductions. There are a number of, I'm not going to get into detail here, but there are a number of interactions between the NOL carryback rules and how they might interact in particular with the international provisions of the TCJA. And a lot of those are relatively negative for taxpayers. And so people are going to need to be aware of all those interactions as they figure out whether they want to carry back their losses. For example, the Section 250 GILTI and FDII deduction is limited to taxable income. So if you carry back your NOLs to 2018 and 2019 and reduce your taxable income, that also reduces your Section 250 deduction, which could then lead to a reduction in your FDII or an increase in your GILTI liability. It could also free up or you lose the ability to use the foreign tax credits in the earlier year, which would free them up and carry them forward. But the foreign tax credit carry forwards are subject to a 10-year limit. So it's possible that those might go unused. So there are a number of these kinds of things that the taxpayers need to keep in mind as they figure out whether they're going to take advantage of the 5-year carryback. There are similar suspensions. Oh, go ahead.
No, go ahead. I was gonna jump in and talk about some of the administrative things that taxpayers might want to keep in mind, but I'm going to wait until you're finished.
Oh, no, that's okay. I was just going to point out that there were also some similar suspension with respect to the limitations on pass-through business losses against non-business income, so that those can be taken into account by individuals. And Jen, you might actually want to comment on that piece.
Yeah. So Lisa, you gave a laundry list of things that folks would want to consider with respect to the technical nuances of the code and how this applies. And I think there's also some administrative things that folks will want to keep in mind as they think about whether or not they are going to take advantage of this NOL carryback. Obviously, if you're able to carry back to pre-2018 years, you're going to be able to obtain a refund of pre-TCJA rates of 35%. So that is, obviously Congress was intending to put money back in taxpayers' hands, and that helps do that. But I think that we need to think about the fact that in instances where you're carrying back 5 years, you're going to be carrying back to years that you may have believed were closed, and now that in effect can reopen those years, reopen them to the extent that you would be due a refund. The service could make adjustments there, and so to the extent that you are carrying back, I think folks should just consider that they need to look to see what their risk was back then. If they had some risk and that they thought their statute had closed and they had taken certain financial reporting positions related to that, they may need to reevaluate that if they're going to carry back those 5 years. Also, when you're carrying back on amended returns, you also probably will trigger state tax filings. So you just need to think about the implementation of getting those amended returns filed for state as well. And then as far as your transactions go, for companies that had acquisitions recently, some of their transactional documents effectuating the transaction perhaps didn't talk or even, consider the NOL carryback because it wasn't something that the TCJA allowed. And so perhaps those transactional documents are silent to who can or how would this work. And so I think that taxpayers who may be considering it should revisit those transactional documents to see what they say and if there's any opportunity there to address that with the other side. And then finally, I think, and probably one of the most important things that is on people's minds with respect to these NOL carrybacks is really kind of the speed in which they're going to be able to get the money. And, you know, folks that have an NOL that they plan to carry back from 2019 and 2020 when that time comes, they'll obviously consider using the Form 1139 or 1045, and they will, you know, seek to carry it back that way so that they can get that refund within 90 days instead of waiting for it to work its way through the process, especially if the refund is sizable and it would be subjected to joint committee review and approval. And so I guess one of the questions that I have, two questions that I have for Mike and Sunita in this area is, you know, I think that the service has in the past exercised some of their discretion when it comes to extending the filing periods for things like the 1139 and the 1045. And so is there anything that you guys are thinking about with respect to doing so for 2018 so that taxpayers who clearly have missed the boat on filing a timely 1139 for 18 could actually go ahead and do that so that they can get that refund in 90 days? Or alternatively, are you considering some sort of expedited processing so that taxpayers can get that money back as quickly as possible to keep afloat?
Yeah, and this is Mike. I'll let Sunita jump in on the procedural kind of technical processing questions, but just to recap everything that you said, Jen, and Lisa as well. We've gotten a large number of comments on the Section 172 modifications, the NOL provisions in the CARES Act, and are working. We've got a number of groups together, cross-functional within Council, to get guidance out, really in kind of two buckets that I think both of you addressed. The procedural issues and rules, including the 1139 timing issue that you raised, Jen, and a lot of other kind of procedure-related questions as well. How do you go about taking this NOL carryback to prior years and monetizing those losses through refunds as quickly as possible? So we've got a set of procedural rules that we're thinking about there. And then also substantively, as you pointed out, Jen and Lisa as well, there is some complex interaction with the NOL rules, in particular with the international provisions, and we've gotten a lot of comments, even one this morning, about the interaction with the GILTI high tax exception, which is just in proposed form right now, and a request to move forward on that quickly because there is intersection with Section 172 and the modifications, intersection with the BEAT rules, a lot of issues that stem from the rate differential that you pointed out, Jen, that if you can carry this back to before 2018, then you've got the 35% rate. So we know taxpayers are thinking about all of those and modeling out the best way to utilize this provision in the CARES Act. And we do have, as I said, two buckets of guidance that we're thinking about, both the procedural rules and the substantive rules. Probably ask Sunita to chime in. I know on the 1045 in particular and the 1139, the quickie refund claims, we are, from Council's perspective, have heard the request. But Sunita, maybe you can talk about kind of the operational issues that you're thinking about there as well.
Yeah, on the 1139s, you know, those are mailed in and they go to our Ogden Service Center and I think to one more, which is closed. Ogden is, so just for folks to know, and maybe we'll talk about it later, other than our one service center in Ogden, all of our service center has been closed because of shelter in place. So forms like 1139 that are mailed to the service centers, as you can see, there's a concern that the mail is not being sorted because the employees are not being able to go in due to reduced staffing, and we are really concerned about the health and safety of our employees, and we're trying to work as much as we can where we do send people in to promote social distancing. So if 100 people were going in the building on an average day when everything was good, we can't do that. We have to send far fewer number of people in, and so we are rotating, as many other agencies and employers are doing. So we understand the need for liquidity, and we understand the need for taxpayers and to get the refund money because it is really important at this point, but we also have to balance it to protect our employees. So we really appreciate the patience. We're going to work it, the best we can, first in, first out basis. But the environment, as you know, it's hard to see what is down the future in, day to day or week to week. So we are trying to figure out how to get to those 1139s as soon as we can.
And I guess, Sunita, just to follow up on that, several questions have come in expressing concern that given TCJA and that carrybacks were not allowed, do you still have the personnel experience in handling those types of claims?
Well, yeah, I think we are going to be able to. We will probably have to train folks, and that's not always an issue. I think at this point the primary issue for us is having the ability to find them in the mail. In some places the mail is not being delivered, so we can't even get to them. But in Ogden, where most of them go, the mail is being delivered. But yeah, because of changes to the legislation, whether it's TCJ as a result of these new legislations, that's an issue. But I think that's somewhat, if I were to say, something easier issue. We can train folks. We have people. We can do it virtually, so that we can overcome. At this point, what we're trying to do is what we can do. It's pretty much a day-to-day. What we can accomplish virtually, remotely, what we can't do because we just aren't able to get to the place in person.
Great, thank you. And then I think we can move on, and we'll try to answer more questions when we get to that part of our program, to the modification of the limitations on business interests. And I think, Lisa, you were also going to put us off on that.
Yes, thank you, Sheri. So the CARES Act would also temporarily increase the limitation on interest deductions that was imposed by the TCJA. Specifically, it would increase the 30% limitation. Currently, it's 30% of adjusted taxable income threshold. It would increase that threshold to 50% for tax years beginning in 2019 and 2020. It would also allow taxpayers to elect to use the 2019 adjusted taxable income in lieu of 2020 for purposes of calculating its 2020 limitation. This is to help, as expected, many businesses' income is going to go down in 2020, and so it allows you to use a higher 2019 income figure and therefore a higher interest limitation. I also wanted to point out, too, it's not on the slide, but the CARES Act does correct an error in the TCJA, which allows qualified improvement property to qualify for the 100% bonus depreciation instead of writing those improvements off over a 39-year period. And this is particularly helpful to the hospitality industry, restaurants, retail, and the like. And many of those taxpayers may have elected out of the 163J interest limitation in favor of the longer depreciation periods because, of course, it was an easier choice when the qualified improvement property didn't qualify for bonus depreciation. And so I wanted to pose the question to Mike as to, I guess it's twofold. One, these taxpayers are going to need guidance on how to retroactively claim bonus depreciation if they now qualify. And second, if they did elect out of the 163J interest limitation, will they now be able to revoke those elections?
Yeah, and those are both issues that we've heard, Lisa, and working to quickly address them. I think that obviously when the rules were written in the elections, the rules around elections and elections were taken, we were in a different paradigm. So I think some consideration is being given to how we best do that. I can't say that any decisions have been made yet. We've been trying to triage a lot of the CARES Act provisions, but those questions you raised are certainly front and center for us, so I can't really give any additional guidance as to how we'll resolve them, but we are thinking very seriously about them, and we'll try to get something out as quickly as possible. I know that doesn't answer your question, but I do want to let people know that we are certainly assure you that we're thinking about them and realize the circumstances that we're in.
No, that is helpful. Thanks, Mike. And then I think, Jen, you were going to cover a little bit about how these rules apply in the partnership context.
Right. They apply just a little different than in the corporate context. So for partnerships, the increase in ATI limit from 30 to 50 that Lisa talked about applies only to the 2020 tax year. So in lieu of permitting partnerships to increase their limitation in 2019, what the CARES Act does is it provides a special rule that allows partners who received partnership allocations of excess business interest in 2019 that were non-deductible because of the 30% limit. They can elect to have, or actually unless they elect out, 50% of that excess business interest that's allocated to the partner in 19 that was computed using that existing 30% ATI limitation at the partnership level. That amount is going to deem to have accrued in 2020 and can be taken into account on the partner's 2020 tax return without further limitation under 163J. And, you know, I think as we looked at this provision when it first came out, you know, I guess we were scratching our head, like what was the goal here? Why treat partnerships differently than corporations? And, you know, I guess we've just assumed that it was likely attributable to the fact that the CARES Act was passed after the original March 15th due date for filing of 2019 calendar year partnership returns. Although I guess my observation was, although I think practically every large partnership probably did not file on their original due date and was probably planning on filing on an extension, but putting that aside, I think that was probably at least part of the reason for why they took that approach. And so the CARES Act will just exempt those partners from 163J limitations with respect to 50% of the excess business interest that's allocated to them in 19. And it doesn't necessarily provide them with relief that's equivalent to the benefits in both timing and amount that they might have derived if they took that in 19. But on the other hand, it is going to reduce that administrative burden that folks have with respect to the complexity of amending partnership returns. So I guess to the extent that you are a partner in a partnership, you just have to keep your eye out for how this will all work, because if there are elections to be made, one election applying the 2019 amounts to 2020 as far as the ATI limitation goes, calculation goes, that is something that would be done at the partnership level, but the election to deem the 50% of the 2019 interest is done at the partner level.
This is Mike. Just while we're on the topic of partnerships, one of the comments that we've received is under the BBA, there's generally the concept of amended returns doesn't generally exist under the BBA, and so we've heard requests. There are some exceptions to that we can provide. So specifically with respect to the CARES Act provisions, is there some flexibility we can give with respect to filing either amended returns or, as we did last year, in part in connection with some of the GILTI regulations, providing for superseding returns for partnerships. So an issue we're considering to facilitate utilization by partnerships of some of the CARES Act provisions.
That's great. Thanks, Mike. So I guess now should we talk for just a few minutes about the recovery rebates for individuals. So we've talked about the provisions that are namely applicable to businesses, but also a big component of the CARES Act was the recovery rebates for individuals. And so what the CARES Act does in that area is it creates a refundable credit that's going to be paid in cash. It sets up some limits, so individuals with AGI of $75,000 or less are going to get $1,200, or in the instance of a head of household filer, their income can be $112,500 or less. For married couples filing jointly with an AGI of $150,000 or less, they'll have a check of $2,400. And then there's an additional $500 for each qualifying child. Now, this credit does have phase-outs, so it's eliminated entirely for individuals with AGI of $99,000 and over, or head of household filers with one child and an AGI of $146,500 and over, and then married taxpayers with no children and AGI of $198,000 and over. So in order to be eligible, you have to have a Social Security number in order to receive or be considered, and non-resident alien individuals or anybody who's claimed on someone else's tax return as a dependent would not be eligible for the credit. So what the IRS will be doing is they will first look to a taxpayer's 2019 return to see if they have filed it. In many instances, taxpayers will have not, but for those that have, they're going to look at the 19 return to understand, what their AGI is, how many dependents they have, are they married, filing jointly, did they file head of household, how many qualifying children do they have, and that will form the basis of how they compute the recovery rebate. For taxpayers who haven't filed 19 yet, then they'll turn to look at 2018 to compute that. And then in the instance where a taxpayer has not filed a return, there's many reasons why someone may not have to file a return or hasn't filed a return. The service then would look at things like Social Security Administration information. So, and then finally, I think the service is looking to do direct deposits of these checks, and they would be utilizing the direct deposit information that would be reflected on the taxpayer's returns, as I mentioned. So I'm going to pause there and really turn it over to Sunita. I gave the basics, but I think that it's important to hear from you guys on how you're actually implementing this and what's the next steps.
Hi, this is Sunita, and you covered it really well. So what we are going to do is we're going to look at the 2019 returns first, and if the return hasn't been filed, we will look at the 2018 returns. Clearly, we have direct deposit information from a number of taxpayers, and so that is we're going to be able to send them the economic impact payments. That's the official name, economic impact payments to the taxpayers. As soon as our programming is done, and we are hoping sometimes in the latest by mid-April or even sooner, people should with direct deposit should be able to get that money. So for those we don't have direct deposit information, we will be sending checks. But in order to make sure that that people who we don't have direct deposit information but would like to provide it to us, we are working on an app that will be on irs.gov that people can use and provide that direct deposit information. So our goal is to be able to provide money directly in people's account as soon as we possibly can. Of course, it would be first with direct deposit and then going to paper checks. But if we do not receive direct deposit information, for those we will be sending paper checks. And so that's the basic essential how the program will work for most people. Now there have been a lot of questions on SSA 1099 and RRB 1099s. I don't know if it's in the next slide or not, but I can cover that now. So the statute.
Sure, yeah.
Go ahead.
Yep, go ahead, Sunita. Thank you.
Okay, the statute specifically speaks to using the SSA 1099 and RRB 1099 information. We will do our best to be able to use what we have, that information, without requiring seniors to be able to file, provide us with information to receive their economic impact statements. There will be instances where we're trying to figure out what is the easiest way for people who are non-filers and are not SSA 1099 or RRB 1099 filers who receive the 1099s, and we have no information on how we can make it as easy as possible for those people to receive the economic impact statements. I think the one message I want to get out is, for the most part, for the vast majority of Americans, they will not need to do anything to receive their rebate or economic impact payments. And if those who have to, those who may need to do something, we will make it as easy and as the least burdensome that we can do to be able to provide those economic impact payments.
Sunita, thank you. I think that is something that is concerning a lot of people, and it sounds like you're working on a mechanism for folks to provide direct deposit information if that hadn't been previously provided. Has there been any thought, or is there going to be a mechanic, some type of, something that folks can interface with the IRS to perhaps provide information of a change in circumstances, perhaps folks who were joint filers before who are no longer joint filers, folks who maybe were sadly victims of domestic abuse, or others that want to report changed circumstances to make sure that the economic impact payment goes to the person that it ought to go to?
We have to think about all those things. Currently, the statute does require us to look at 2019 and 2018 returns, and it also says that if there needs to be a true-up, like somebody received less money than they should have, and I know this is not a lot of comfort to people where every $500 may matter. It matters a lot that they true up in 2020 when they file their return, and if they got less, they can get more information. But I'll take that back as to mechanism for people to tell us if their filing status has changed. But it's the web app we are creating is not set up for that. It is one other thing I want to say is that it's very similar to Where's My Refund. That's what we're hoping to do and replicate as much as we can. So people will know where it'll say Where's My Economic Impact Payment or something similar to that, and it'll work for two functions. They can find out where the economic impact payment is and provide us with the direct deposit information. But at this point, we are thinking about your question, but honestly, I don't have an answer I can give you.
Well, we hope you continue to think about it, because we do know that's creating a big problem for, again, a very vulnerable part of our taxpayer community. So thank you for giving it consideration, and we hope to continue the dialogue, perhaps with suggestions that come from the community. That would be fantastic.
We'd love to have any suggestions that people have.
Great. And we're going to run through just a couple of additional tax provisions for individuals just to make sure folks are aware of them. We're not going to go through them in detail today. I think, although not a tax provision, we continue to remind folks of the expanded unemployment benefits, that it's now including more individuals, self-employed, independent contractors, kind of helping our gig workers participate in some of the stimulus programs or programs that help kind of keep people on their feet. Not only does it expand availability to the types of workers, but there's also increases in benefits. And again, I'll refer most folks to the statutes, but it does provide up to an additional 39 weeks of benefits under the Pandemic Emergency Unemployment Compensation Program. Also, retirement withdrawals, that's another source of liquidity for folks who need those. Again, folks, the penalty is waived. Folks can take a coronavirus distribution up to $10,000. And unlike other programs, they can also, should they find that they don't need those funds anymore, they can repay them and repay them back into the retirement account. There's also a variety of some student loan relief payments, and interest on certain federal loans are suspended for now, and employees who receive certain employer-sponsored education benefits, those will be temporarily excluded from income to a degree. Charitable contributions, again, that allows taxpayers, all individuals, whether they itemize or not, a $300 deduction. It also dramatically increases, that removes the limitations for individual taxpayers. They can deduct any qualified contribution in 2020 up to their adjusted gross income. And there's also benefits to corporate taxpayers, although we're talking about individuals. They've also increased
the deductible contributions up to 25% of taxable income. So just a brief mention of those provisions that folks can take a look at in more detail on their own. And I thought we would turn now more, again, to hear from the IRS on some additional updates. Particularly, there's been a little confusion on the filing and payment deadlines. I think we understand what's supposed to happen with income tax returns that were due April 15th and our first quarter estimates. But Jen, I know we had questions about other types of deadlines and extensions, and that you were going to help us talk through those.
Sure. So I guess let's talk for just a second about 2020-18. And Mike, before I start pummeling you with questions on this, was there anything that you wanted to kick off with respect to the extension of the filing and payment deadlines under that recent notice?
Sure. Thanks, Jen. Yeah, a couple just general observations, and I think this will be obvious to everyone, but the situation that we're dealing with now with the coronavirus emergency is, I think, very different than anything that we've had to deal with before in terms of the relief that we provide under Section 7508 Cap A. The scope, the geographic scope of the emergency is obviously unprecedented, as is the evolving nature of it. So that does have an impact on our thinking on 7508 Cap A. And when Notice 2020-17 was issued, which is just probably not even a month ago now, I think we were all looking at this situation slightly differently, or perhaps very differently than the way we're looking at it right now. So we started off with 2020-17, which was simply a postponement of the payment obligations otherwise due to be made on April 15th. And that was followed in relatively short order as the situation evolved with Notice 2020-18, which also extended and postponed the filing deadlines otherwise due on April 15th. So those are the two pieces of guidance that are out there now. We did put some FAQs out that I think answered a few questions, in particular things like 965, like IRA contributions, things that we could answer relatively quickly as saying those are tied to the filing deadlines. So those are addressed in FAQs. We have received, again, probably hundreds of additional comments in terms of time-sensitive dates in the Internal Revenue laws that are not covered by that April 15th keyed payment and filing deadline extensions. So those are all being triaged here. We're considering all of them. We have gone back to take a look at the RevProc, the RevProc 2018-58, to look at the laundry list of 250 plus items that can be extended under that RevProc. The regulations 301.7508A list a number of other actions that can be extended and often are in the event of a natural disaster or emergency. So all of that is on the table right now, and I do expect that we'll have additional guidance very soon, responding to many of the questions that have come in since the issuance of Notice 2020-18. So we're certainly very cognizant of some unique or perhaps not so unique situations for taxpayers who are not covered by the relief that's out there. And I do expect to have something out very soon that will address many of the concerns that have come in.
So Mike, that guidance will be great, and I think I have two buckets of taxpayers that have different needs, but have very pressing deadlines that can be looming in the future. One are our fiscal year filers. So we know that calendar year filers got an extension for filing and payment. But what about our fiscal year taxpayers? I know that there are some corporations who are in the same boat and hurting, need that extension like our calendar year taxpayers. And so I know that the FAQs that were released about 2020-18 did say that the extensions were not for fiscal year filers. Is the service considering extending that? And if so, what are the service's views about a delay or postponement for fiscal year filers?
Yeah, that's certainly probably at the top of the list of things that we're considering. As you mentioned, Jen, the current guidance is keyed to an April 15th deadline, and many fiscal year filers do not have April 15th filing or payment deadlines because of their fiscal years. And that includes not only fiscal year taxable corporations, but also many tax exempts. who may have a 990T UBIT filing and payment requirement. So we're certainly very cognizant of that universe of taxpayers, both taxable and tax exempt, that may not fall on April 15th in terms of their filing and payment obligations. So that is at the top of the list, or near the top of the list in terms of things that we are looking for an additional way to address. So stay tuned for something on that, hopefully in the very near future.
Great. And then the other bucket of taxpayers that I just want to take a second and talk about are ones that may be filing petitions with the U.S. Tax Court. And we're especially concerned about taxpayers who are economically distressed, who may be seeking help with a clinic to file petitions. Obviously, those clinics are most likely shuttered right now, working remotely if they can, but for some of these individuals that would be seeking their assistance, they don't have access to technology to email or meet virtually with these clinicians. And so to the extent that they have a 90-day letter that they need to petition the tax court on, but really struggling to do that, is there anything that the service is considering with respect to extending the filing petition date in light of COVID?
Yeah, that's also near the top of the list, Jen, and we've had discussions with the tax court about that as well. We obviously share an interest in ensuring that those taxpayers do have access to the tax court forum, as they typically do outside the context of emergencies like this. So there are a couple of things. Sunita will speak to this in just a moment with respect to the People First initiative, but in the medium term, if not the shorter term, a way of addressing that is the ramp down in IRS enforcement activity. So the volume of stat notices being issued should be reduced dramatically in the short to medium term future, which will address part of that concern. Obviously, that doesn't go to the taxpayers that have a stat notice that was issued prior to the onset of the coronavirus situation. So we do recognize that there's a very important population of taxpayers out there, and the regulations that I cited earlier, the 7508 Cap A-1C regulations do speak to our authority, as does the statute, to extend the deadline for filing petitions in tax court. And the 2018-58 Rev Proc builds on that and gives a fairly comprehensive list of the types of petitions, not only just straight deficiency petitions, but other types of petitions as well. So very cognizant of that. Also cognizant of the fact that at the moment the tax court's clerk's office is not open because of their own coronavirus situation. So we've been speaking to them about that, and again, mutually focused on this population of taxpayers who, as you mentioned, Jen, not only are working as we all are with the current situation and impacted and perhaps not able to go to work, but also are additionally impacted by the closure of VITA sites and taxpayer clinics that don't have, and IRS walk-in centers, and don't have the typical resources at their fingertips. So that's all very high on our list of issues to address, along with, as I said, dozens or hundreds of other requests for various time-sensitive deadlines to be postponed. So, again, stay tuned for something very soon, but those two matters, the fiscal year filers and the tax court petitions, are two that we've been very focused on.
Oh, thank you. And we have, and I know you guys issued some FAQs on Notice 2020-18, and I understand that you had received lots of different questions that had come in and feedback, and that helped form the basis of the FAQs. And so I guess as a practitioner in the community, we greatly appreciate the opportunity to share our concerns with you and have you guys consider it and think about rolling out responses and answers to the questions. So thank you for that first round of FAQs. And there's just a couple things I want to draw folks' attention to. And Mike, you may want to say some more things about the FAQs. But I guess two things that jump out to me is that with respect to the estimated income tax payments. So unless something changes, right now, second quarter estimated tax payments are still going to be due on June 15th. And our first quarter estimated tax payments are postponed from April to July. So we're going to have two quick payments in quick succession and kind of out of order. So just keep that in mind. Unless the service does something to further postpone things, we're going to be looking at a big grouping of payments due at the beginning mid-summer. Another thing, a query I have with respect to the due dates. So the FAQs note that your due date for your federal income tax return for 2019, which was due originally on April 15th, is now postponed to July 15th, 2020. And so I guess the query I have, and Mike, while this is not something that anybody's going to be focusing on right now, 3 years from now, when we're talking about statutes of limitation and how we start computing statutes, is the July 15th date just subbed in for April 15th so that any returns that were filed in between April 15th and July 15th are just going to be deemed to have been filed on July 15th? Or is there going to be some nuance with the rules? Because there is some nuances when it comes to the statute of limitations when a taxpayer files prior to an original due date or after the original due date, but not on the extended due date, in the middle, in between, or right on the extended due date and it's received after but posted. So there's some nuances there, and I think that 3 years from now we're going to need to keep our eye on what that statute of limitations is based upon this postponement.
Yeah, that's a good question, Jen, and something to make a note of. In terms of triaging the incoming, as you said, we do have a few years to make sure that we get an answer to that question and have some clarity on that. I think that's probably relatively straightforward, but it's a very important point for people to keep in mind. I would also note, and I should have said this before as well, the current guidance that's out there and what we're contemplating, it's focused on this July 15th deadline. There is no reason why, for taxpayers that are faced with filing constraints, just as in any normal period, there's no reason why you can't file an extension and get your automatic extension to October 15th as well. So, and that can be done through the IRS's free file portal on the website for individual taxpayers. So I would just, as we go through all of this, and it's certainly not something that's available to taxpayers that normally go to VITA sites and use hands-on tax return preparers, but that is an option for some people that need more time. That's always available, and that electronic portal is all still up for the IRS, and they're processing those as they would in the normal course. But you raised some other questions as well. Statute of limitations is an important one, and it's something that I think we have a little bit of time to focus on. But the more that we can kind of anticipate those questions coming up several years from now, the better, that we can at least get those on the radar screen, and if we don't get them answered immediately, be aware of them and get those answered in due course.
Thank you, Mike. We're going to move on to the People First initiative, and I'm sorry to tell everyone we are running out of time, so we've been trying to answer questions throughout the program that have come in, and we do realize and we can see that there are some other topics which I think could take an entire hour for us all to better understand, but as I mentioned in the beginning, this is the first of a series that the ABA tax section will be doing, and we will be doing some specifics, certainly on PPP, certainly on the employee and retention credits and interactions of those things. So please, everyone, stay tuned. I want to just try and get through a couple more slides for today. Going to the People First initiative.
So
sure.
I think on the PPP, there are a number of questions. We're expecting more guidance from the SBA and Treasury this week, so kind of stay tuned. And,
great.
Independent contractors are eligible. They just have an application deadline of next week instead of this Friday. So hopefully that clears up a bunch of questions.
Thank you, Anne. That's very helpful. So for those of you who are seeking information, it sounds like some guidance will be forthcoming. And the People First initiative, Sunita, I didn't know if you can tell us what can we expect with that?
So the intent of the People First initiative was to make sure that this time people come first, in the sense that includes taxpayers, that includes our employees. The taxpayers, because we know they're undergoing economic hardship, so we try to lessen burdens on them or lessen defaults that would occur automatically if they fail to make some payments. For example, if they aren't able to make payments into the installment agreements, it will not automatically default. If people want to continue to make those payments, that's fantastic. We always take the money, That's not an issue, but if you cannot, we just wanted to give assurance that automatic default has been turned off. The same thing for offers in compromise, for example. We have suspended new liens and levies with regard to automatic under-reporter matching. Some of the notices had already gone out. It takes us a while because we are big machinery to turn off certain things. So those had already gone out and were in the process. They went out, but we will not be sending new notices at this point. We made it clear that exams will continue, the ones that are open, to the extent we can continue them without too much burden on taxpayers providing some documentation they may not have. But in this day and age, a lot of people have their books and records electronically, so we think that can continue. And the presumption being that, for the most part, taxpayers want us out of their business and want the audit over with if it can possibly be done. But we are not looking to open new audits, but we also understand that we have to protect the government's interests. We will open audits depending on what the reasons and the circumstances are. So that's a very quick overview. IRS appeals will continue to work. They cannot hold in-person meetings, so I think they're encouraging people to respond as much as they can, as quickly as possible. They have been holding video conferences, I think, even before this. They'll probably increase the scale of that. That was very fast.
Yes, and we appreciate that again.
And I do want to talk about this. This is an important electronic signature and documents. We understand that taxpayers cannot go to the office, or taxpayers and representatives cannot see each other at this point. They may be in different cities, even in the same city, because of social distancing. So we have we issued a memorandum, which is really puts us on a very far on the ledge than we have ever gone, but it is very helpful, where we have said that the taxpayers and the IRS can exchange documents, including extensions of statutes of limitations and assessments, agreed assessments, through the best source is faxing. If you have a fax machine, that's the most secure way for us to exchange information with you. You can fax it, it shows up on our e-fax system. So that's a secure line. If you can do that, we really suggest that would be the first way to do it. If you cannot, we have authorized our folks to send and receive documents through emails. Sending the email is completely the choice of the taxpayer. We want to say over and over again, it is not a secure email, so do not put anything in the subject line or the text of the email. If you want to attach something, attach it, zip it, and then call us with the password. We will do the same. We'll send you a document, we'll secure zip it, and and password protect it, and then we'll call the taxpayer with the password so they can open it. So we can maintain a lot of security doing what we are doing pursuant to the memorandum. So this will really help keep the audits moving, because, like I said, most taxpayers would rather have us be done with and gone, and so they can go on with their business. But protect the taxpayers, their families, our employees and their families from being face-to-face or going into the office to pick up mail. What this memorandum does not do is authorize electronic signatures on forms. That's separate. This is solely between the conversation, electronic conversation and transmission of documents with regard to an ongoing case. I think that was a very fast way of going over this slide.
It's been a fast way of going over everything. We're a lot of information we've had today to try and impart to get people thinking about things, and just from the unbelievable magnitude of questions. Again, we're sorry not to have answered all of them, but I think there are probably over 400 questions that have been lobbed in, so just so everyone knows what we're talking about. And Jennifer, I know you had one quick one.
Well, and I think, I think Sunita just touched on it, but I just want to reiterate, because I know that a lot of taxpayers, kind of for the same reason, Sunita, that you mentioned, folks cannot get into the office, cannot meet, with return preparers. a digital signature is not permitted on a paper filed return. I just want to confirm that with you, because I know that there was some confusion when this electronic signatures notice went out as to whether or not that applied to it. But I just want to confirm with you that as far as any paper filed returns go, that needs to carry a wet signature or original signature. Is that correct?
Yeah, and I can. This yes, memorandum doesn't change any of that.
Right, and this is Mike Jen. That is correct.
Okay. I think that's really important, so people don't file returns thinking that they've got it and they don't have a valid filed return. So
that is correct.
And since we are at the end of our time, and I know some folks have hard deadlines and whatnot, I do want to make a few announcements for everyone. One announcement is that the slides will be available and I believe posted on the ABA website and the ABA tax section website, and I want to point people to some other links and additional resources that we've provided in the slides. An important one is the ABA tax section COVID-19 web page. That's a new web page that's been developed. There's an IRS Coronavirus Resources Center. We've also provided links to all of the legislation as well as to some of the congressional committees so that you can find information and take a look at some of these things yourselves. I think some of the questions that I've seen come in are actually answered by the statute. Others are not. And we're going to be packaging up these questions so that the IRS and our other and congressional leaders, to the extent necessary, can be thinking about these and thinking about where to go. I don't know if there's going to be a Phase 4 legislation of any sort, but I guess we should wait and see. And I want to thank all of our panelists today for a really spectacular program. That it's a lot of information. It's a lot for all of us to try and learn quickly, so that we can help everyone during these challenging times and to try and lessen some of these economic impacts that are occurring. And I think that's all we have today, but contact information for some of your panelists are on the back. I don't know, either Mike or Sunita, if folks have comments or things they want they want to get to the service, is there a preferred method for that?
I will have to get it to you. I think there's an email address on our irs.gov where people can send comments in, and our communication folks can collect that.
Great, and we will be forwarding along to the service and organizing the questions that have come in. So thank you all for our very active audience. We really appreciate it. And I think that wraps up our program for today.
Thank you.
Thanks, Sheri.
Thank you.
Thank you. On behalf of the American Bar Association, the ABA Taxation Section, thank you for participating in this program. To learn more about the sponsors, visit the ABA website at www.americanbar.org. Thank you, and please click on the evaluation link. We value your feedback.